passive activity losses and limitations. And we're talking again here about nothing new. Passive activity losses, these are losses that arise from passive activity, such as rental real estate, limited partnerships, or S Corps, in which the taxpayer does not materially participate. The IRS limits the amount of passive activity losses that a taxpayer can deduct in a given year. It's a nice reintroduction to what we're going to see. The mom and pop exception. This is something to know for sure. The mom and pop exception, think mom and pop. Why is it called that? Well, it's a mom and pop shop. It's a small shop. Small businesses, that's hence the name, applies to certain small businesses. These are often family owned and operated to avoid certain tax rules that would otherwise apply to larger businesses. Kind of the IRS trying to foster competition and allow smaller businesses to grow without heavy regulations and extra taxes like larger companies have. Specifically, this exception allows qualifying small businesses to avoid the passive activity loss rules that would limit their ability to deduct losses from their business activities against their other income. And obviously, we'll see examples how this works. You'll see questions on this on the exam, so make sure you are ready for it. Now, under the passive activity loss rules, losses from passive activities such as rental real estate or limited partnerships can only be deducted against passive activity income. It's almost as if I'm saying these things one after another because you really need to know them. Ding, ding, ding. Any excess losses can be carried forward to future years or deducted when the taxpayer disposes of the passive activity. However, this mom and pop exception allows certain small businesses to treat their rental real estate activities as non-passive and thus deduct losses against their other sources of income. We see it just breaks that rule. What's the normal rule? It's that we can only deduct passive losses against passive gains or passive income. In this case, kind of breaks that rule. We'll talk about the exceptions and anything that is constantly changing year to year due to inflation that will be in our resources within the lesson to pull up for you. But normally there are some things within this rule that do not change year to year. Let's keep moving on and powering through. To qualify for this mom and pop exception, you must meet 2 criteria. First, the business must be owned by individuals or by a limited partnership or S Corp that only has individual partners or shareholders. And what does this mean? So it's just got to be a small business, right? Owned by individuals. This business can't have any corporate shareholders or anything like that, or limited partnerships or S Corps. And S Corps we know from our lesson on business structures and entity types and all that. The S Corps generally are meant to be smaller businesses as well due to the restrictions on who can be a shareholder there. So that is just beating that to death. This is for small businesses, and the IRS is really trying to make sure it's only used for small businesses. Now, second, it must meet certain gross receipts thresholds. Now, specifically, the business, in order to qualify for this exception, must have average annual gross receipts of $25 million or less over the preceding 3 years. That's just something to remember, to memorize there. For example, let's say that a married couple owns a grocery store that generates $10 million in annual gross receipts. They also own a small apartment building that generates $50,000 in annual rental income, but has $80,000 in expenses, resulting in a $30,000 loss for the year. Now you might be saying, hey, this doesn't sound like a very small business. Well, technically it is. I mean, it's a very small business compared to some of the larger businesses out there. For me, I think I'd be living pretty sweet if I had this setup. Rental building, grocery store. I mean, hey, maybe it sounds like a lot of work, but doing pretty well for yourself. So we have a $30,000 loss, passive loss, because of this small apartment building. So apartment building doesn't have to be small. It's just an apartment building. You've got rental income. That's passive. Normally, you'd only be able to take this 50 minus 80, giving us negative 30, which is a 30 loss. Normally, you'd only be able to deduct that against your passive income. So that's normal passive activity rules. We would normally not be able to deduct this loss against their other income, which presumably is their small grocery store income. However, because their business meets the criteria for the mom and pop exception, yeah, this very much sounds like it's well under that 25 million or less. They can treat their rental real estate activities as non-passive, and we can deduct this $30,000 loss against our other income. Good there. That's how it applies. Make sure you're keeping rules like this always on your mind as you're running through questions. It could pop up out of nowhere, sneak attack you, and you should always be ready for whether it's that $3,000 rule or any of these other rules that just pop up when you least expect it. Real estate agents. So we mentioned earlier how there are specific rules for real estate agents. And why is that? Well, because generally real estate's passive, but if your business, what's your profession, your career, what do you do day to day? It's being a real estate agent, so dealing with that. You'll see different rules here. Now, if a taxpayer qualifies as a real estate professional, rental real estate activities are considered active rather than passive because it's just what you do day to day. It's your business. This distinction is going to be important because under our normal passive activity loss rules, Passive losses can only offset passive income, and limiting the taxpayer's ability to use these losses from rental real estate to offset other income. However, when rental activities are considered active, which is beneficial for us here, these limitation rules do not apply, and this real estate agent taxpayer can use the losses from rental activities to offset other types of income. And how do we consider ourselves a real estate professional? Well, you might consider yourself a real estate professional, but how does the IRS consider you a real estate professional? You got to meet two criteria here. You, first off, must have more than 50% of the taxpayer's personal services during the year are performed in the real estate business. So if you do like 3 different businesses throughout the year, it's got to be more than 50% of what you do during the year goes toward any rental activities, real estate activities such as developing, constructing, acquiring, converting, renting, managing, leasing, and brokerage activities. So 50% of what you do. And how do you more so deal with that? Well, you perform more than 750 hours of services in real estate businesses each year. That is our hard and fast amount. This requirement helps ensure that the taxpayer is actually significantly involved in real estate activities and not just engaged in them on a sporadic or limited basis, which would not make you a real estate professional under the IRS's rules. Now, again, you might consider yourself as a real estate professional in your own mind, and good for you, happy for you, but the IRS has these rules. Make sure you are familiar with them. Now, it's essential to note that meeting these criteria do not automatically make all rental activities active. A real estate professional must also materially participate in each rental activity to treat it as active. Material participation that involves regular, continuous, and substantial involvement in the rental activity. So even if what you do, you meet all these criteria here, if you just then let's say you do this for 2 properties and you meet the criteria, but then there's a third property where you only spend an hour a year on it, you wouldn't be able to consider that income and losses from that one property because you only spend an hour a year on that one property. So not only do you have to meet these criteria overall to be considered a professional, but for each property, you need to materially participate in it. And like I said, we will talk much more about material participation later. However, you can kind of generally get the idea that you need to regularly engage with it, continuously engage with it, and be substantially involved with it. All right, let's see an example here. Well, we've got John, and John happens to be a full-time real estate agent and also owns 3 rental properties. He's going to work $2,000 per year as a rental real estate agent and spends 100 hours managing each of his rental properties, totaling 300 hours. First, we're going to determine if John qualifies as a real estate professional. First, our rule, more than 50% of John's personal services during the year are performed in his real estate business. So John works 2,000 hours as a real estate agent and 300 hours managing his rental property. So in total, how many hours does he work? He works 2,300 hours during the year. How do you keep track of that? In terms of practical means for doing this in your life, can't say I'm too sure how the IRS would want you to keep track of that, but you could probably keep track of that somehow. Real estate related work. So you are going to do, well, looks like in this case, 22,000 hours as an agent and 300 hours as a manager of rental properties. So a total of 2,300 hours. What is your percentage here? Well, your total hours you're working for the year, 2,300, and your total real estate related work is 2,300. So it looks like 100% of John's work is going to be within the real estate realm. And as such, John meets the first criteria because more than 50% of his personal services are performed in the real estate business. Now, if he did a little accounting work on the side, that would take away. If he did 100 hours of accounting work, then it'd be 2,200 hours divided by 2,300 hours. We'd have a little bit less. So just keep in mind that's how that would work. But in this case, we have 100%. Next up, John performs more than 750 hours of services in real estate businesses during the year. So even if you meet the 100% threshold or 50% threshold, you are going to also need this minimum of 750 hours during the year. And John spends 2,000 hours as a real estate agent and 300 hours managing his properties. In this case, you're well over 750. You're doing 2,300 hours. That is a lot more than what we need, which is 750. Now, since John meets both criteria, he does qualify as a real estate professional. However, he must also materially participate in each rental activity in order to treat it as active. Now, assume that he does materially participate. And to be fair, a lot of questions you see on the exam, it might just tell you straight up, hey, this person materially participates. That's totally fine. Though sometimes you could see hints as to if they materially participate. And again, we will continue to see examples of that. Now let's look at the financials for his rental properties. Rental property 1 unfortunately had a $5,000 loss. Rental property 2 has a $3,000 gain. And rental property 3 has a $7,000 loss. So what do we see here? We see our netting together our losses. We've got total of $12,000 of losses, and we've got a total of $3,000 of gains. Now, since John is a real estate professional and materially participates in each rental activity, these PAL, passive activity limitations, do not apply. Therefore, John can use the $12,000 in rental losses to offset his $3,000 in rental gains. First, you would just say 12,000 minus 3,000. That is going to leave you with $9,000 left to go out and use against your active types of income, offsetting that, which you normally would not do if you were not a real estate professional considered under the IRS. That was a pretty well done slide. I think we knocked that out of the park and pretty crystal clear. Hopefully you feel the same way. Let's keep powering through. Excess business loss. We talked about this earlier and mentioned it, but now we're actually going to see it a little more in depth. Excess business loss limitation. This is a limitation on the amount of business loss that taxpayers can deduct in a given year. This limitation is applied after the passive activity loss limitations have been considered. That's important to note as well. The excess business loss restriction aims to prevent taxpayers from offsetting other income sources with significant business loss, which could result in paying little or no income tax, and that's not good. We want to, as the IRS wants some tax there. Now, an excess business loss for the year is calculated as follows. First, we're going to determine the excess of aggregate business deductions for the year over the sum of aggregate business income for the year. So that would be our loss. Compare the calculated excess to the threshold amount, which is an annually changing threshold. And as such, we have that in our resources section. Make sure you memorize that. And if the calculated excess is greater than the threshold amount, then you have an excess business loss. So there's an amount. And if you have losses in excess of that, then first, that's how we determine if we have an excess amount. That's not too crazy of a process. The excess business loss limitation, this is going to apply to all types of business income, whether they are active or passive. Now, if a taxpayer has an excess business loss, they cannot deduct the portion of the loss that exceeds the threshold amount. Instead, that is going to be carried forward as a net operating loss to future tax years. Something we will see is I've got a carry forward schedule that it's got year 1, year 2. It's going to show all the losses and carrying them forward, how that all works. In practice, in reality, that's just going to be a big old beautiful spreadsheet in which you're keeping track of your losses. I mean, maybe at a certain point you use a software for it because it's a business that's big enough for it. That sounds good to me. Let's keep going through. Now, taking a look here, we've got some repeat information. And just please, look at it again if you want to see it again. Key points I'm going to say here. We've got $25,000. Now, this is, generally speaking, going to be the amount used for the mom and pop rule as well as for the real estate professionals. Now, you may be limited up to $25,000 of using passive activity losses against non-passive income. If you meet certain criteria, we'll see many examples of that, and we'll see multiple choice questions about using that $25,000 amount. And passive activity credit. If the taxpayer has a passive activity income in excess of passive activity losses, the taxpayer may be eligible for a passive activity credit. Again, just the key points here that we've seen time and time again, bringing them back so you remember them. I'm going to beat them to death. Repetition is how we memorize. Material participation. I know I was promising it, and finally we have arrived. Now, a passive activity, this is a trade or business in which you do not materially participate. As such, what determines material participation? As I said, it could be as simple as the question saying they do or do not materially participate. Now, the distinction between passive and active activities is crucial because, as we've seen, there are different deduction amounts, different limitations depending on what type of income we've got going on here, what type of activity. Now, material participation, again, very important in terms of if you are actually a material participant, you are going to need to be involved in the operations on a regular, continuous, and substantial basis. The question could also just say, hey, this person is involved on a regular, continuous, and substantial basis. And as such, you would know that they are a material participant. However, we do have even more criteria that we're going to see. Now, there are many tests for material participation. As I said, they could just tell you. They could say that it's regular, continuous, or they could say they do not regularly, continually, and substantially participate in the business. However, you must meet at least one of these tests in order to be considered a material participant in a specific activity. And as such, based on what we've seen, It generally is advantageous to materially participate because then it's active and you can use that as a deduction. So again, this is a good thing. You want to meet one of these tests. The most common test is going to be participating in the activity for more than 500 hours during the tax year. So again, that's just an important key point to note. But there are other tests as well. So the individual's participation in the activity constitutes substantially all the participation of all individuals, including non-owners, in the activity for the year. So this could be something like a partnership. It could be a side business. It could be you're working at a bakery. It could be tutoring for the CPA exam. The individual participates in the activity for more than 100 hours during the tax year, and no other individuals participate more hours than the taxpayer. Again, some more things that you could see, more criteria, more checklists, one criteria to meet. The individual has a significant participation in the activity, and the individual's total participation in all significant participation activities exceeds 500 hours, which we saw that's one of the more common ones. The individual materially participated in the activity for any 5 years during the 10 tax years that immediately precede the current tax year. And lastly, the activity is a personal service activity, and the individual materially participated in the activity for any 3 tax years preceding the current tax year. Making sure we're familiar with these. It's not going to be absolutely critically essential to memorize all these. You'll kind of get an idea if they are a material participant. Memorize them if you have the mental space for it. Say there are other things to memorize before this, but definitely something you should be familiar with. We've got an example here for passive activity loss and limitation. Let's say that an individual taxpayer owns a rental property that generates $20,000 in rental income in year 3. However, the taxpayer also incurs $30,000 in rental expenses, which includes mortgage interest, property taxes, and repairs. Now, if the taxpayer actively participates in managing the rental property, they may be able to deduct up to $25,000 in rental losses against their ordinary income. So again, this $25,000, this is the amount that we use if it's the mom and pop exception, if it's the real estate professional exception, if it's the material participant exception. So again, this $25,000 is important to memorize there. However, if the taxpayer does not actively participate in managing the property, then the rental losses are considered passive activity losses. In this case, let's assume that the taxpayer actually does not actively participate in managing the property, and therefore the $10,000, so that's the $20,000 of rental income minus the $30,000 of rental expenses, rental loss is considered a passive activity loss. Now, passive activity losses can only be used to offset passive activity income, such as rental income from other properties or gains from the sale of rental properties. If the taxpayer has no other passive activity in the same year, we're going to carry this forward to future tax years, and we're getting closer to that loss schedule, that carry forward schedule. I'll show that to you. It'll all click, it'll all make sense. Assuming that there's no other passive activity income for year 3, this would be carried forward because it's not mentioning anything else there. However, let's say the taxpayer does actually have other passive activity income in year 3. The passive activity loss can be used to offset that income. Now, for example, let's say that the taxpayer also owns a second rental property, and that generates $15,000 in rental income in year 3. If this rental property is also considered a passive activity, the $10,000 passive activity loss from, over here, can be used to offset the $15,000 passive activity income, which would result in a net passive activity income of $5,000. Gotta love these examples. Make sure you understand them, and feel free to rewatch the clip, rewatch the portion that you are not familiar with. Passive activity loss carry forward schedules. We're going to see one on the next slide. This is going to track losses from passive activities that cannot be deducted in the current year, but can be carried forward to offset passive income in future years. Now, maybe this is something that TurboTax or H&R Block or whoever you use, maybe your own accountant, just does for you. But this is how it all works. You have to understand how the software works to pass this exam. Now, passive activities, these are those in which you do not materially participate. Beating it to death, these terms, I'm really, these are things where if you don't get this right, I'm going to pull my hair out. And with the amount of people studying for this exam with us, that's going to be a lot. I'm going to have to pull out one piece of hair at a time if I'm going to have any hair at all. Such as rental real estate or business where you're not an active participant. The schedules format well into Sims, so be prepared to see one. And I do sincerely mean that, and we'll see it right here, and I'll keep talking about it. So seeing something like this formats very well into a Sim, just like a lot of the tax forms format well into Sims. 1040 is Schedule C. It's very easy for them to build a Sim that looks exactly like those, so I would very much prepare for those to be Sims. No matter what exam, whether it's the financial exam, we're dealing with audit, a cash rec that formats well into the sim. So something like this, I mean, you can look at it and you're like, wow, I could see the boxes there being sims. So let's walk through what we're seeing here. There's no additional information. This is just a demonstration of it, but you could have a lot of information and you could have to fill this out yourself. And we'll have sims on this as well. So your total passive losses, let's say in year one, you just have $12,000 of passive loss. And a sim could also have a bunch of other items, right? Determining the mom and pop exception, determining the real estate professional, dealing with all of those. So just other items to keep in mind. Let's say that you've got $0 of loss carry forward from previous years. Sounds good. Total losses, in this case, other losses, nothing. Passive income, nothing. There's no allowed deduction because there's nothing else to offset. So we've got $12,000 passive loss from this year one, and we're just carrying forward that full amount to year two. Sounds good. Now in year two, in this year, we've incurred $8,000 passive losses. Now we carried forward $12,000 from the previous year, so we've got total passive losses of $20,000. However, we still have $0 of passive income, so we can't deduct anything. So we're saying we're going to continue to carry forward this $20,000 into future years. Next year, $5,000. We got $5,000 of passive losses this year. Man, we're taking hits, but it looks like we're becoming more and more profitable, less and less losses each year. So we have 20 we carried forward from the previous year. And in this case, we've got total losses of 25,000. We carried 20,000 from the previous year cumulatively and then added another 5. So we've got total losses of 25. However, thankfully we're starting to make money, right? We see we're slowly making money here. Now we've got $10,000 of passive income. So we can take $10,000 as a deduction, meaning 10,000 of the 25 can be deducted, leaving us with 15,000 of losses carrying forward. Then in the next year, we've got a $4,000 loss, again, doing a little bit better. We've got 15,000 carried forward from the previous year, year three, for a total of $19,000 of losses. And hey, look at that. We have $12,000 of our passive income from the year. So looking very good to me. Then what can we actually take this year? Well, again, it's only up to the extent of passive income because we don't have any of those exceptions stated out. So in this case, we have $12,000 that we can actually deduct. 12,000 of this 19,000 leaves us with $7,000 that we're going to carry forward into future years. Now, as we see in year 5, we've got $3,000 of losses, carrying forward that $7,000 for a total of $10,000 of losses. But hey, look at that. We've got $15,000 of passive income. As such, we can take the full $10,000 of deductions that we've been carrying. We're just keeping it in our pocket for the future for something like this. We can deduct $10,000. We're going to have $0 to carry forward. And as such, this year, we're finally going to have $5,000 of income that we have to pay taxes on. I know that's not displayed here, but we have $15,000 of passive income. We've got $10,000 of an allowed deduction. So $5,000 is the passive income we'll have to declare and pay taxes on. And that is a loss carry forward schedule. Again, you could see something like this. It could vary in complexity on the exam. Maybe, like I said, they do have a lot of intricacies determining material participation, determining these other exceptions, loss limitations, bringing in some other concepts as well. But make sure you understand this, just the basic level. This is the most basic level you'd see it at. Keep practicing. You will be able to get this. Let's see an example here on suspended losses. Now we've got Smith, who is a passive investor in 4 activities, and they have been profitable in previous years. Now we've got the profit and losses for the current year are as follows. Activity A looks like lost 40,000. Activity B lost 60,000. Oof. Activity C made 25, and activity D made 10. We net these all together, so we've got total losses of $65,000. Now, what amount of suspended loss should Smith allocate to activity A? This is an interesting point. This is an interesting way about how we allocate losses between multiple activities. Because you could have a sim where you've got a 1040, right, individual income taxes, just dealing with that. And then you are going to have to maybe exhibit with one activity. You get an exhibit with activity B, another exhibit with activity C, etc. D. So we have to allocate these suspended losses between certain activities to offset them against those particular activities in future years. So how are we going to do that? Well, my job is to demonstrate it for you through an example. Now, passive activity losses are generally only deductible against passive activity income. Probably the 18th time we've seen that sentence. If there's a net passive loss and multiple loss activities, the suspended net passive loss must be allocated to loss activities in proportion to the amount of loss generated by each activity. So how are we going to get to this 26? Since A and B are the losers here, we have $100,000 total of passive losses. So the amount of $65,000 of suspended loss that we would allocate to activity A would be 40,000 divided by 100,000, which gives us 40%. 40% of 65,000 gives us 26,000. And then obviously the other 60% would be allocated to activity B. And that's what we would allocate for future years. So this is another type of question you could see. I didn't have a slide going through this conceptually. I think this is just something much easier to see with an example. So if you've got multiple activities such as this, make sure you're familiar on the process of how to allocate the losses between each activity, because then in the next year, A and B could be profitable, and you want to take those specific gains, those losses, and net them together correctly. Got a few more slides before we wrap it up and call it a day. So talking about this $25,000 exception, we've got our three situations that we've mainly talked about here. We got the mom and pop exception, the real estate professionals exception, and the material participation exception. Now, one thing I want to note is that for the mom and pop exception, this is for those who actively participate in their rental real estate activities. And what does that mean? Is that to qualify for the mom and pop exception, you're not following those material participation criteria. But in these cases, you need to follow different ones. You need to actively participate, and you need to own at least 10% of the rental activity. So active participation, it's actually a less stringent standard than material. So material participation, we saw all those different rules. We saw all those different situations, right? So just to keep in mind, it's actually easier to go for the mom and pop exception. However, we do see that there's a phase out. So this, first off, you're only able to claim up to $25,000. So it's easier to fulfill the mom and pop exception, but you're only able to claim at most $25,000 in passive losses against non-passive income. So that's one of the big differences here. In terms of phase out, if your AGI is, let's say, less than $100,000, you can take the full $25,000. If your AGI is above $150,000, you do not get any of the mom and pop exception money. So you cannot use any of your passive against your active. However, if it falls somewhere in between, it's reduced by 50% of the amount by which your AGI exceeds the $100,000. So we're going to see an example of that, how this works on, in a second, but it will phase out as you proceed. And then again, once you reach an AGI of $150,000, you don't get any of that $25,000 benefit. Now, for real estate professionals and for just in general, a materially participating person in an investment like this, the $25,000 allowance does not apply. So for real estate professionals, we kind of talked about this a little bit, beat it to death. Feel free to read through this again. We're not going to see an example on this again. And then material participation. Now, those generally who materially participate, because this is a stricter standard than the active participation here, you can generally deduct those losses against non-passive income without that cap at $25,000. So differences there. Again, just wanted to highlight the differences between these three. Now, the phase out for that exception, here it is. I mean, we kind of saw it again, but saw it on the previous slide, but this is it. This is dealing with the mom and pop exception. This is just a phase out provision. Again, just take a look at this if you want, but this is just a slide going through it. Kind of talked about it, but I'd rather jump into the example, show you how it works, and run through it. So in this example, we've got Morgan, and Morgan is a single taxpayer with an AGI of 150. Okay, that is interesting because we know that it phases out completely at 150. So before accounting for any IRA deductions, taxable, Social Security benefits, or passive activity losses, Morgan has a loss of $40,000 in year 4 from rental real estate in which she actively participated. Now, if this was a question on the exam, we would know to target the mom and pop exception because it says she actively participated. Now, what amount of this loss attributable to the rental real estate can be used in year 4 as an offset against income from non-passive sources? That's going to be $0. Now, passive activity losses can generally only be used to offset passive activity income. We've seen that a million times. Rental activities are considered passive activities irrespective of your level of participation. That's something we saw there. However, individual taxpayers are allowed an allowance for offsetting up to $25,000 of non-passive income if certain conditions are met, such as the active participation, mom and pop rule. So we want to see, of this $40,000, what can we deduct? Well, at most, it would be $25,000. So at most, like we talked about, the maximum amount is $25,000. So it's considered a passive loss, initially suggesting you'd be limited to $25,000. However, this is reduced by 50% of the amount by which the taxpayer's AGI exceeds $100,000. So in this case, you do meet the $150,000 right away. So we know that it's going to be zero. But let's see something different, right? So let's say that your AGI was 125, so in the middle. Well, what's the amount that it exceeds 100,000? If our AGI is 125, we're going to say 125 minus 100 because 100 is the minimum there. So 125 minus 100, that gives us $25,000, and we take half of that. So again, what are we going to do? If this said 125 instead of 150, we would say we have an AGI of 125 that exceeds 100,000, so that gives us $25,000. And then we take 50% of that, so $25,000, and 50% of that is going to be $12,500. We're going to reduce this by $12,500, giving us $12,500 remaining that we can take. So again, that is how that would happen if we fall somewhere in the middle of the 100,000 and the 150,000. In this case, because we could just say the rule is boom, we know right away that's what happens. But what is the amount? Let's do this the normal way. If we were going to do this normally, so $50,000 over $100,000, right? We see 150 minus 100. That's $50,000. What is 50% of 50,000? Well, that's $25,000. So 25,000 is disallowed, and the maximum is 25. So in this case, $0 is allowed. As a result here, Morgan cannot use any of her loss attributable to the rental real estate to offset income from non-passive sources in year. Good example there, and let's wrap it up with a nice summary and call it a day.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.